Good morning, I'm Benjamin Sullivan, and welcome to Market Monday for April 20th, 2026. Just 3 weeks ago, the S&P 500 was within a hair of correction territory. This week, it closed above 7,000 for the first time in history. The NASDAQ posted its longest winning streak since 2009. According to some experts, this is the fastest move from a near correction to a new record high since 1928, nearly 100 years ago. That's the story of the week. Let's talk about what it means. Markets have a newfound optimism. A 2-week US-Iran ceasefire took effect in early April, conditional on reopening the Strait of Hormuz. Oil pulled back from its highs, and Israel and Lebanon announced a 10-day ceasefire last week, shifting sentiment. Here's the part that matters. Nothing has been resolved yet. As of this date we recorded, the US-Iran ceasefire expires on Wednesday. However, the peace talks scheduled for this past Sunday could change that. The reality is oil is still elevated, and a leading economic forum's 4.2% inflation forecast has not been revised down. The Fed is still on hold. The market didn't wait for resolution. Instead, it priced in the expectation of resolution. And that distinction is everything. Markets move on expectations, not always outcomes. This has been the pattern since 2020. Sharp sell-offs are followed by sharp recoveries, and the recoveries start while the news is still bad. Think back to Liberation Day. 1 year ago this month, the S&P 500 dropped sharply on the April 2nd tariff announcement. Just 1 week later, on April 9th, the S&P gained 9.5% in a single session. That was the biggest one-day gain since 2008. Investors who sold on April 2nd missed the entire snapback. Going back 5 years, the S&P 500 bottomed on March 23rd, 2020, while COVID cases were still accelerating and the economy was still shutting down. The market didn't wait for the news to get better. It started recovering while the news was getting worse. Going back further to March 2009, the S&P 500 bottomed while unemployment was still rising and GDP was still contracting. The recovery started 6 months before the recession officially ended. There is one more data point worth sitting with. JP Morgan has studied the best and worst trading days over the past 20 years. 6 of the 10 best days occurred within 2 weeks of the 10 worst days. Miss the worst days, and you almost certainly miss the best ones too. In each case, investors who sold during the fear locked in losses. Investors who stayed invested captured the recovery. The recoveries will never announce themselves. Staying invested through March took discipline. The headlines were dire. Oil was above $100. Stocks and bonds were falling together, and traditional safety nets were not working. And that fear was real. This is why we build portfolios the way we do. Not because we can predict the bottom, but because we know we can't. The portfolios are designed to withstand the drawdown and then capture the recovery. That's the job. Here's the thing about this moment. Someone in your life almost certainly went to cash in March. They are watching the market at all-time highs right now, and they are feeling it. That conversation will never be easier to have than it is today. If you know someone who stepped to the sidelines in March, this is the conversation they need. Send them this video or send them our way. We'll take it from there. That's all we have for you today. As always, thank you for watching this week's edition of Market Monday. Join us again next Monday for more of the insights that matter to your money.